In this video, we'll analyze the stock FIGR. FIGR is a tokenized stock that can be purchased over permissionless blockchain technology. We'll cover how FIGR disrupted the home equity line on credit market and is positioning itself as a platform that disintermediates the private credit market. As always, we'll talk about the market opportunity, the valuation of the FIGR stock, and broader market and company risks. At the end of the video, I'll give you my personal buy and sell targets based on FIGR's valuation and growth trajectory. This video was inspired by an article of Inversion Cap, which analyzed FIGR's business mechanics, and a Substack article of Artemis, which analyzed specifically the FIGR stock. Most of the information in this video is coming from these two articles. I'll link them in the description below. Not financial advice, let's get right into the video. All right, why do we talk about FIGR stock in the first place? As you can see here, FIGR had its all-time high not too long ago. In the beginning of 2026, so roughly 2 months ago, the stock was trading at almost $78. And since then, it came back down almost 50% to $39.50. It's currently trading at $38. So roughly a minus 50% correction. And the IPO was back in September with an IPO price of $25 a share. So this naturally begs the question, is FIGR stock over or undervalued? Was the sell-off justified? So we'll talk about that. But let's first look at some stats here. Like I said, the stock is trading around $38 to $39 at the moment. The market cap of FIGR, including the diluted shares, is roughly 8.5 billion. The enterprise value is 7.3 billion. And 9 different analysts actually say a fair value target would be $45.89. While the stock was while the stock is 50% down from its all-time high, the Q4 2025 numbers actually were really impressive. 91% revenue growth, 426% adjusted EBITDA increase, and 51.6% EBITDA margin, with an increase of 31.4% in the EBITDA margin. So those are some impressive numbers. So let's see where we stand with the FIGR price at the moment. Let's first talk about what FIGR actually does. So FIGR is a lending facilitator. What does that mean? A borrower can put up his house as collateral and get a so-called home equity line of credit, or in short, HELOC. And traditionally, which is nothing else than borrowing money against the value of your house. That is very common practice. And in this case, the house is the collateral for the loan. You would traditionally go to a bank to facilitate that loan, but FIGR opened up a competition business to the banks and to facilitate these loans. Why would a borrower go now to FIGR instead of a traditional bank? Let's compare them directly here. What would you think right now? What are the costs of a bank issuing a loan for a borrower against his house? You can stop the video and think for a second here. The answer is it costs roughly $11,400 for a bank. How much does it cost for FIGR, would you assume? Well, FIGR can facilitate this loan at roughly $750. That's over a 90% cost decrease for FIGR. Then when does a bank break even? So how big of a loan has the borrower to take out against his house in order to make it worth it for the bank to issue this loan and to offset the loan costs of $11,400? The answer is the borrower needs to take out a loan of $367K in order to offset the costs of this loan that got issued by his bank. In contrast, FIGR only needs a $25,000 borrow against a house in order to offset its $750 costs. How long has the borrower to wait until the process is done, until all the documents are signed and he got the money that he wanted to take out against his house. With traditional banks, it's roughly 45 days until the borrower gets his money. And with FIGR, it only takes 5 days. So now you can see FIGR is really way more attractive for borrowers to issue a home equity line of credit via FIGR versus a traditional bank. So let's break down the cost reduction in detail. In total, there are 3 layers how FIGR saves money during the loan issuance. And the first layer is the loan origination. And the secret here is that FIGR digitized all of this process. So if you look at the individual items here, the sales channel, the underwriting of the house, the property valuation of the house, the document and prep and closing, compliance and servicing, those are all done by humans and physical documents, which takes a lot of time and costs a lot of money. And FIGR was able to digitize that process and therefore make it a lot cheaper. For example, for the underwriting of the loan contract, they use an AI system, and the property valuation is also done by automated valuation models. So there are no labor costs involved here, which suppresses the costs of a loan, of course, significantly. So on the first layer, which is the loan origination, FIGR manages already to save almost $5,000 against a regular bank. Important to mention here is that this is not necessarily a mode. Any well-funded fintech could digitize their process and take advantage of that savings cost. Now, the second and the third layer is actually where FIGR's mode is. The main thing here is that FIGR uses the blockchain as a settlement and registry. So that makes the whole process faster, more transparent, and less human labor intensive. And therefore, there's another cost saving of over $1,000 in this process. And in the third layer, they're creating an on-chain marketplace where the loan gets a warehouse carry if it is necessary and a third-party review. And again, FIGR is managing to save significant costs here. $595 are saved in this process versus a traditional loan issuer. To give you an overview here at the end, in layer 1, where FIGR doesn't have a mode, it saves $5,000 roughly through digitization of loan issuance. In the second layer, there's the blockchain registry and over $1,000 are saved. And in the third layer, again, roughly $600 are saved versus a traditional loan. That adds up to $6,749. And because there's additional overhead, because of administration and bureaucracy, basically, an additional $3,500 is saved, which gives FIGR this massive cost advantage when issuing and administering loans of 93% in total. Here's a nice overview of what that actually means for FIGR in terms of higher margins, where loan origination for traditional banks was not profitable before. The table is constructed by inversioncap.com. They have published a really good article where they give an in-depth overview over FIGR the business. If you want to read that, I will link that in the description below. But what we can see here is that the average loan size on FIGR is $90,000, which, remember, is not even profitable for a traditional bank. A traditional bank needs a loan of over $350,000 to be profitable. But even if the loan was $25,000, FIGR would break even on the loan, whereas a bank would bear the cost of $10,250 still. All right, now we are going to talk about how FIGR actually monetizes step by step its home equity line on credit loans. In the first step, FIGR originates the loan in a direct customer relationship, so in direct interaction with their customers, or over their partner network of other banks and credit unions. If FIGR has the direct customer interaction. So if the customer goes directly to FIGR, there is an origination fee that FIGR charges up to 5%, minus the cost that FIGR bears. We talked about this in the beginning, which is roughly $750, and that is the origination profit. What is happening with this partner network? We have talked about the big difference in profit for loan sizes under $350,000 between banks and FIGR. Banks are actually unprofitable under $350,000 loans, and FIGR is already profitable with a loan bigger than $25,000. So banks and credit unions really have this problem of unprofitability in the range between $30,000 and $350,000 loans. FIGR, on the other hand, has the problem of not being a trusted brand yet. So they're fairly new on the market, and the main demand for these $30,000 to $350,000 loans is coming to these traditional banks and credit unions. So FIGR solved these problems by making deals with an expanding network of traditional loan issue partners that can use the cheap loan origination system of FIGR to make these smaller to mid-sized loans more profitable for traditional players. When a loan gets issued by a partner over FIGR's loan origination system, the partner bears all of the loan origination costs, but shares part of the loan issuance fee with FIGR. That means in dollar terms, FIGR makes less money when a loan is originated by the partner network, but the money that is taken in is almost pure profit for FIGR. This positions FIGR more as a loan facilitating infrastructure and explains the high margins that we saw in the first slide. The loan origination process also includes tokenizing the loan and putting it on FIGR's own built blockchain, which is called provenance. In step 2, the loan needs to be warehoused. What does being warehoused mean? These loans are warehoused in a warehouse hold on the blockchain, just like clothes are warehoused in a warehouse for a physical store. And this physical store wants to sell the clothes to an end customer, and also FIGR wants to sell their loans to an end customer, which are pension funds and institutions. And in this time period, the loans are bundled together and sold in 100 to 500 million batches, which have specific risk parameters like credit scores and geographical distribution. Why are institutions buying these loans? Because they have to manage the money for their customers, which are different worker unions, and the goal is to get yield on this money, which has relatively low risk. And until FIGR has collected enough individual loans that can be bundled together, which approximately takes 14 days, the borrower already wants their money. Traditionally, warehouse banks like JP Morgan have served lenders, but like everything in traditional finance, they are taking high fees and a lot of time to warehouse these individual loans. So what FIGR did instead, it made these short duration warehouse loans accessible to DeFi users over permissionless protocols like Camino Finance. Finance users can finance these loans with USDC and receive 8% on their money by doing so. In addition, they can withdraw their money anytime because these 14-day warehouse loans are rolling over constantly. FIGR, on the other hand, has greater flexibility to warehouse these loans by eliminating the restrictiveness of these warehouse banks. FIGR calls this product Democratized Prime. In the next step, these loans then are sold on FIGR's marketplace to institutions. FIGR gets a sale on commission here as the marketplace that matches buyers and sellers of these wholesale loans. In the final fourth step, FIGR is retaining servicing rights, and for that service, they are getting 25 basis points of the total loan amount yearly from these institutions. FIGR also made recently a deal with Agora, which will bring car loans to FIGR Connect, and they want further expand their product line to small business loans that will be sold over FIGR's Connect marketplace as well. When it comes to a market opportunity, As we discussed before, FIGR has already gained a lot of traction in the HELOC market. The biggest opportunity that FIGR is seeing right now is expanding into the first lien market. A first lien loan is a loan where the lender has the first priority claim on the property if the borrower defaults, whereas HELOCs are mostly second lien mortgages. Usually, first lien mortgages serve for borrowers to buy or build a house, whereas in HELOCs, people are putting up their house as collateral in order to get a loan. The first lien market is way bigger than the HELOC market and therefore should bring in a lot more revenue with similar margins. In addition to first lien, there's a lot of other market verticals FIGR wants to expand into. For example, we already mentioned the car loans and small business loans, but FIGR also is building a crypto and stock exchange, which is based on their blockchain infrastructure. As we can see here, these are all very big market opportunities, and if FIGR can expand in any of these markets successfully and gain a little bit of market share, their revenue and therefore their stock price should increase significantly. Let's talk about the growth projections for FIGR. In my personal opinion, the overall macro picture for stocks and crypto is not great in 2026 because of cyclicality and recession fears, but will recover in 2027 and 2028. In addition, I believe stablecoin supply on blockchains will grow substantially over the next years. Let's first dive into the growth projections of the core lending product. FIGR's revenue has grown with its lending product 50% over the past 2 years, as you can see here. For 2026, I assumed slower growth rates because of the macro uncertainties, but I think growth will get back to 50+% in 2027 and 2028. When we take a look at the digital asset business, I believe this market will actually shrink in 2026 because of the crypto bear market, but the numbers will recover in 2027 and 2028. I assumed 100% growth in both years. And the reason for that is I assume an increasing number of people will not only manage their mortgages over FIGR, but also their crypto and stock investments. So they will use FIGR as an all-in-one platform. I also think that in 2027 and 2028, FIGR will hit their goal of 60% or more EBITDA margin because the majority of the revenue will come from their lending partner network and not FIGR itself, which we talked about earlier, won't give them as much revenue, but the margin will be way higher because they're barely having any costs managing these loans over their blockchain infrastructure. And the result will be that EBITDA in 2027 will go slightly above 1 billion, and in 2028, FIGR will reach an EBITDA of roughly 1.6 billion. All right, in the next step, we have to talk about the valuation. If my assumptions about revenue and margin growth should be correct, we need to figure out what an appropriate multiplier is for FIGR. And the main variable I'm focusing here is the enterprise value to EBITDA. Traditional mortgage originators like Rocket and UWM trade at roughly 10 to 15x EV to EBITDA. But capital markets infrastructure trades between 20 to 25x EV to EBITDA. So depending on how you categorize FIGR's business, these would be the stock prices that the FIGR stock could reach over the next 2 years based on my assumed revenue numbers. When we talk about risks, there are, of course, many risks. First of all, we have the macro risks. I already assumed that we won't have a good macro picture in 2026. If that would lead to a housing crisis, for example, with a broad devaluation of the housing market in general, then people would obviously have less loan appetite. Then extreme rate changes would probably indicate that we are running into an economic crisis. The company-specific risks are there could be technical problems with the blockchain. FIGR could fail to expand their successfully their product line, especially if the first lien expansion fails, the market would re-rate the growth of the stock way lower. Then, of course, there are hacks and data leaks, and other competitors could enter the market and make the life of FIGR more difficult. Then, of course, there are always regulatory risks, especially for FIGR here, because they're operating at the intersection of securities law, crypto law, alternative trading systems law because of the blockchain, and the housing market. So if any of these areas should have severe restrictions by the government, FIGR could be affected in a bad way. Then also the stock could be diluted in the future, and insider selling could suppress the stock price for a while as well. The co-founder alone, Mike Cagney, was selling 2.25 million shares over the last couple of months. This insider selling could easily persist over the next 1 to 2 years. All right, let's talk about the conclusion here. At what levels will I consider to buy? Since I consider FIGR financial infrastructure because of their clear positioning as a facilitator of loans for traditional players through their blockchain technology, my hypothesis is that you could justify a buy between $30 and $40. This is close to the lower end of the 20x multiple valuation of my conservative chosen 2026 target. Between $40 to $60, the stock is a hold for me. Below $30 is a clear value buy for me. Why? Because even if FIGR underperforms my revenue projections by 30% and gets re-rated to a traditional loan originator, there's still some potential upside over the next years, but only marginal downside. If the stock goes over $60, I would sell over the next couple of months because we're getting close to the best case scenario for 2027 already, which even if we would get there, we will likely have some pullbacks along the way. Let's say, for example, FIGR has disappointing quarter results that will likely lead to some pullbacks from the $60 mark, where you can buy the stock cheaper again and at a better valuation multiple. And that is the end of the video, guys. Hit the like button if you got a better idea of FIGR stock, and subscribe to this channel for more fundamental stock and crypto analysis. See you in the next video. Bye bye.